The Federal Reserve just released something today that should change how you think about your money for the next 2 years. And almost nobody is talking about what it actually says. Kevin Warsh just held his first press conference as Fed chair. And yes, they held rates. But that's not the story. The story is buried in a table on page 2 of a document they released at exactly 2 p.m. today. And when you see what changed, from what they projected in March to what they're now projecting, you're going to understand something that most financial media is completely glossing over. By the end of this video, you'll know exactly what the Fed just admitted, why it matters for your mortgage, your savings, and your purchasing power, and where money moves when the Fed finds itself stuck exactly where they are right now. And I'm going to show you the one number in today's report that connects all of this and points directly to why Bitcoin's setup just got significantly stronger. Stay with me. This one's important. Real quick before we get into it, if you watched yesterday's video on Bitcoin and the Fed mechanism, today is the data drop that either confirms that thesis or blows it up. I'm going to tell you exactly which one happened. Subscribe if you haven't, because this is part 2 of a story that's unfolding in real time. Here's what just happened. 3 months ago, in March, the Federal Reserve told us that inflation this year would come in at 2.7%. That's measured by PCE, the Fed's preferred inflation gauge. 2.7%. That's close enough to their 2% target that you could almost see the light at the end of the tunnel. Today, they revised that number to 3.6%. Let me say that again. In 90 days, the Fed revised their own inflation forecast up by nearly a full percentage point. That is not a rounding error. That is not a data quirk. That is the Fed telling you, in their own words, that everything they thought they understood about where prices were heading 3 months ago was wrong. Think about what that means for you personally. If you were waiting for rate cuts to bring down your mortgage payment, you're waiting longer. If you were hoping your savings rate would eventually come down to justify refinancing, the window is staying shut. If you've been watching prices at the grocery store and thinking, this has to get better soon, the Fed just told you they don't think it will. Not this year. And here's what makes it worse. At the exact same time they revised inflation up, they revised economic growth down. March projection, GDP growth of 2.4% this year. June projection, 2.2%. Economy growing slower, prices rising faster. There's a word for that combination. It's called stagflation, and the Fed just confirmed it. Not in a speech, not in an op-ed, in their own official economic projections, released today. Now I want to be fair here. 2.2% GDP growth is not a recession. The economy is still growing, but the direction matters. And the direction is less growth, more inflation, and rates staying higher than anyone expected. Now you know what they admitted. But what actually caused this? And why does it matter for where your money goes next? That's the mechanism. And it's more specific than most people realize. So what happened between March and June that caused such a big revision? 2 words. Strait of Hormuz. The closure of the Strait of Hormuz is not just an oil story. Oil gets the headlines. And yes, energy prices spiked. But energy is an input into almost everything else in the economy. And what the Fed's own Beige Book, their ground-level economic intelligence report from 12 Federal Reserve districts, confirmed is that the energy shock has been cascading. One fuel distributor reported their prices jumped 125% in a single month. Airline fares are up 25% since January. One Dallas Fed contact specifically named the strait closure as the reason aluminum prices spiked. And the Cleveland Fed said manufacturers are now reporting the highest share of cost increases since the summer of 2022, when we were in the middle of the worst inflation surge in 40 years. This is not demand-driven inflation. People aren't spending more because they feel rich. The Beige Book said it directly. Middle-income households are, and I'm quoting here, squeezing more life out of every dollar before deciding to spend it. That is the Fed's own language describing your neighbors, your coworkers, maybe you. Not spending freely, squeezing. So what did the Fed do with this information? They built it into their dot plot. In March, the median Fed official expected the federal funds rate to end 2026 at 3.4%. The current rate is 3.5% to 3.75%. Midpoint, 3.625%. So the March dot plot was implying one rate cut by year end. Relief was coming. Today's dot plot, 3.8% for end of 2026. That number is above where rates are right now. No cuts. The one cut that was priced into March is completely gone. In fact, the dot plot is now leaning slightly toward we might need to stay flat or go higher. That is a massive shift in a single quarter. We're about halfway through. You now know what happened and why. The second half is where I'm going to show you what this means for your money specifically, and where the data points for people who are paying attention. Stay with me. So we've established two things. Inflation is worse than expected. Rates are staying higher for longer. Now let's follow the money. Here's a number the financial media glosses over constantly. It's called the real yield, the return on cash after you subtract inflation. Take the Fed's own numbers. 3.8% interest rate, 3.6% inflation. Your real yield on cash? 0.2%. 0.2%. After inflation, your savings account is earning almost nothing in real terms. Now think back. The whole reason the Fed raised rates aggressively in 2022 and 2023 was to make cash attractive again, to pull money out of risk assets and into boring, safe savings. They wanted to slow the economy by making the return on cash competitive with inflation. But look at what today's SEP says. Even at 3.8%, the real return on cash barely exists, because inflation is at 3.6%. They're not winning the inflation fight, they're treading water. So here's the question every saver needs to ask right now. If cash is earning 0.2% in real terms, where does money go? Historically, and I mean going back to the 1970s, the last time we had sustained stagflation, there are two places. Number one, gold. When real yields are near zero, gold tends to outperform because it has no yield to compare against. The opportunity cost of holding gold disappears. Number two, Bitcoin. And this is where yesterday's thesis comes back with today's data underneath it. Yesterday, I walked through the Fed mechanism that connects rate policy to Bitcoin's price trajectory. The thesis was, as the Fed holds rates while continuing to let mortgage-backed securities run off, what I called the QT for cuts strategy, liquidity flows toward hard assets outside the banking system. Today's SEP just confirmed that the rate-holding environment is more entrenched than even March suggested. The inflation the Fed is fighting is supply-driven, from the Strait of Hormuz, not from consumer spending. Which means rate cuts won't fix the inflation, and rate hikes would crush an already softening economy. The Fed is trapped. And when the Fed is trapped, with real yields near zero and inflation structurally elevated from supply shocks they cannot control, the historical pattern is clear. Capital rotates toward assets that exist outside the monetary system's reach. Gold in the 1970s captured that rotation. Bitcoin is the 2020s version of that same trade, but with a fixed supply cap that gold doesn't have, an institutional infrastructure that now exists with ETFs, corporate treasuries, and bank custody that didn't exist 5 years ago. The $160,000 thesis from yesterday isn't built on hype. It's built on real yield math. And today's SEP just made that math more compelling, not less. Now, what do you actually watch for from here? What's the signal that tells you this thesis is playing out or breaking down? Let me give you the exact things to track. Okay, here's the signal I promised at the start. The one number in today's report that matters most isn't the inflation revision. It isn't the GDP revision. It's the 2028 PCE projection. The Fed is projecting that inflation, despite being at 3.6% today, will come all the way back down to their 2% target by 2028. That's 2 years from now. Here's why that matters. That projection requires one of two things to happen. Either the supply shock from the Middle East resolves, the strait reopens, energy normalizes, prices come down naturally. Or the Fed eventually cuts rates to relieve the economic pressure, accepts a little more inflation, and engineers a soft landing. In either scenario, rates are headed lower, just later than anyone wanted. The only scenario where they don't come down is if inflation stays structurally elevated beyond 2028. And the dot plot says that's not the base case. So here's what to watch. Watch number 1, the September meeting. If by September the Strait situation shows any sign of resolution and energy prices start pulling back, you'll see the inflation data soften. That's when the first cut could come back on the table. September is the earliest plausible window. Watch number 2, core PCE month over month. The June SEP pegs core PCE at 3.3% for 2026. If the monthly readings start printing below trend, meaning core PCE is decelerating, the Fed will have cover to cut sooner. Watch each monthly release. Watch number 3, Warsh's language around the neutral rate. Today he used the rate path that puts 2026 at 3.8% and longer run at 3.1%. The difference between where rates are and where they're going is your cut path. Any language that suggests 3.1% is achievable sooner means the path is clearing. Drop a comment and tell me, do you think the Fed cuts before the end of 2026? Or does the inflation revision today push everything to 2027? I read every comment, and I'm going to build a follow-up video around what you're actually wrestling with. Here's the bottom line. What the Fed released today is the clearest picture we've had of where we actually are. Inflation is worse than they thought, growth is softer than they thought, and relief is further away than they told you in March. That's not the narrative you'll hear from most financial media tonight. They'll say, Fed holds rates, no surprises. But the surprise is in the projections, in the gap between March and June, in what that gap reveals about the economic reality the Beige Book had already documented. The everyday American is feeling this. Middle-income households squeezing more out of every dollar. Homebuyers locked out of the market. Savers earning near zero real returns. And in that environment, the capital that can't earn real returns in cash looks for somewhere else to go. If you want to go deeper on the Bitcoin mechanism specifically, how the rate path connects to the $160,000 target, I have the full breakdown from yesterday linked in the description. Start there if you haven't watched it. And subscribe, because between now and September's meeting, there's going to be a lot of data that tells us whether this inflation is rolling over or staying sticky. I'll break it down every time something changes. See you in the next one.